The next panel is on regulatory policy, looking at the fixed income perspective. We're now going to be speaking with David Bullen, the chair of the panel. David is the Secretary General of the Electronic Debt Market Association in Europe. David, welcome to the show.
Dan, thank you for having me. Great to be on this virtual event.
So tell us, what are the key elements of the MiFID II review that fixed income traders might be concerned about and will learn about coming into this panel?
I think the clarity probably exists around the stuff that's going to come this year. So if you like, the emergency COVID-related or COVID-driven changes to MiFID II. So things like research, investor protection, those areas that the immediate changes are focused on. There'll probably be less clarity coming out of this panel about what's going to happen next year, because as you probably know, the Commission and ESMA have consulted on MiFID II, and they haven't really pronounced yet on what will change. However, I think we will be hearing from the non-regulators on the panel about what they would like to see changed in the structural changes of next year. So can't really speak to what those suggestions will be because they've kept those to themselves, but hopefully they'll be making their feelings pretty clear.
Excellent. And who have we got on the panel?
We have two flavours of the buy side, one from the UK in the form of the Investment Association and one from the German market in the shape of BVI. So that's Ross Barrett on one side and Rudolf Siebel on the BVI side. And then to add to the mix, we've got the trading venue represented by MarketAxess in the form of Jason Waight. But clearly, the most important to have there is ESMA and Charlotte Sickermann, who's representing ESMA for us from the regulatory side. So we should have a well-rounded panel.
Do you think there might be any curveballs thrown by any of the panellists at others? Any challenging questions?
So we are going to talk a little bit about Brexit in the context of MiFID II. And there's an interesting link between the last bit we're going to cover, which is the CSDR settlement discipline issue. It's not MiFID II. But it's clearly one area where the UK authorities have been very clear that they're not going to follow the settlement discipline regime. They've said that very clearly. The Chancellor even mentioned it in the written answers in Parliament. So the question underlying that is, if that can be different from the UK's point of view, is there anything about the MiFID II regime, UK style, that could be different? That's the curveball that is not probably going to be answered on the day, but it's certainly going to be alluded to. And with settlement discipline, it's clear where the UK is heading.
David, I'm looking forward to this panel.
Excellent. See you then, Dan.
Hello and welcome. Thank you very much, everyone, and thanks and welcome to this panel. We are indeed joined by Charlotte, Ross, and Rudolf will be joining us shortly if he's not already on board. So he's having a few technical difficulties. Just a reminder, some administration points for the panel. Please remember the press policy applies. Chatham House rules apply. You need to check any quotes, any journalists there with the speaker before quoting them. And also there is an opportunity for Q&A in two forms. You can either raise your hand if it's an immediate and urgent interjection you'd like to make, and also there's a Q&A box at the bottom of your screen. So please put the questions in, and I will be endeavouring to get to as many of those questions as possible over the next 30 or 35 minutes or so. I think we've already introduced all the panelists, but I just want to check that do we now have Rudolf Siebel from the BVI online?
We just have problems having the camera.
Okay, that's fine. No problem. We can hear you loud and clear, Rudolf. We're just going to kick off and get into this session. Charlotte, if you don't mind, I'm just going to come to you first, and if you wouldn't mind, not everybody is as familiar. I can see we're building participants, 58 people so far. Not everybody's familiar with the MiFID II review process. So could you just familiarise us with what's gone on? There's been consultations earlier in the year by the Commission and by ESMA, but where are we now, and what's been the process that's been followed, and what are ESMA doing about the review process itself?
Sure, happy to do so. So I will briefly explain what's happening on the side of the European Commission, and then mainly focus on what's happening on ESMA side, given that this is driven by ESMA. So on the EC side, you all are aware there was a consultation earlier in spring. And the Commission published a proposal for a targeted MiFID II review focusing on investor protection issues in July. So this was part of the COVID packages. Negotiations on this proposals have already started, and the ambition is to finalize the negotiations by the end of the year, because this is part of the COVID package, so it's time is of essence here. Then, from what I know from the Commission process, is that they are planning to look into the MiFID review next year. So we could then expect a legitimate proposal probably around spring or maybe a bit later, 2021. It will then focus on MiFID issues. And then in particular, my guess would be on transparency and the consolidated tape. But also, I mean, just to be clear, just because it says it's MiFID review, it doesn't mean that it's only limited to MiFID issues. It could also be that then some parts of MiFID II are picked up in that review. It's not only limited to MiFID issues. Maybe moving then to the ESMA process. Because ESMA, we started the MiFID II, MiFID review already some time ago in 2019. We already delivered some reports on areas I'm sure you're well aware, like on market data and the equity consolidated tape, but also on commodity derivatives, equity transparency, and the non-equity SI regime. We are working on a number of reports that should then be finalized soon. I think the most important one then for this audience would be the one on non-equity transparency, which we then intend to submit to the Commission still in this month. We will also publish towards the end of the year the review report on SME growth markets, and we will shortly launch consultations on a couple of other reports. So one will be the functioning of the organized trade facilities, the OTFs, where we also plan to consult in September. And then later, towards the end of the year, we will also consult in the area of algo trading.
Okay, Charlotte, thank you very much for painting that picture. So basically a very busy and a lot of issues to be dealt with. I can see that. So I'm going to come to Rudolf first if he can get himself off mute and be ready to speak. But I think this is an ideal opportunity with all this reams of issues and also reams of consultations, submissions and documents. It would be an ideal time for the panelists, not you, Charlotte, but the other panelists, if you like, to pick out the highlights that they would like to accentuate around what it is about MiFID II review or MiFID II regime that they would like to see adjusted or changed, perhaps even areas where they would like it to remain the same. But let's talk about the changes first. And Rudolf, if you're available, what would you like to highlight in the next couple or 2 or 3 minutes to ESMA as we have her undivided attention with Charlotte looking on?
Good. So thanks. Sorry, with the VPN tunnel, the video doesn't work. I'm very sorry. We have, not specifically with ESMA, but more general in the MiFID and BMR context, obviously several requirements. One is sort of fund specific. It's in the fund area, never really clear when do you apply only UCITS and AIF rules, and when do you apply MiFID rules, i.e. the delineation between individual and collective portfolio management, especially when it comes to delegation of portfolio management. It's sort of unclear how that is handled. The BaFin wants more to see it as individual portfolio management, even if it's done by a fund management company, while the French seem to go on the side that everything done by a registered fund management company should be collective management, i.e. MiFID not applied, which I think would be our preferred way of action. On the eligible counterpart and professional side, we think, and some has been picked up in the quick fix, that there are too many information requirements and reporting requirements to eligible counterparties and or professional clients, which could be reduced. For example, useless information like the ex ante and ex post cost information, or the portfolio depreciation reporting, the 10%, which could be deleted for such client groups. On the market infrastructure side, we will divide into that more. We clearly support the COVID measure to exempt SME research from unbundling as an optional matter, but more importantly, exempt the fixed income research from unbundling, because there we paid double, and would very much welcome when that could be just paid through spread. On the more later time, in the context of a formal MiFID review, probably that will not go into the quick fix. We would certainly welcome if the push of ESMA for the consolidated tape would see some fruitful action in order to provide the market with a equity and a fixed income tape, and we have proposals to make that work and not be too overambitious. And finally, we would urge that the wrong trend in MiFID regulation, which works on the basis the exchanges complain about competitors, then go to the regulator, and as the exchanges are sort of always the national crown jewels, they usually get their spiel and something else is prohibited on the market side. Like the dark pools, for example, Then the market side, the sell side, is developing new tools to deal with that regulatory prohibition and offer services requested by clients, especially ref price trading. Then the exchanges complain again, and then the whole regulatory whirlwind starts again, and that has to stop. I think there needs to be a realistic dialogue. What are the expectations in terms of what exchanges need to do versus what other trading venues and market participants like SI can do because their services are thought. And this, we hopefully can get into this dialogue and break this devil's cycle of exchanges asking for something and thereby inhibiting the market, and we end up with this silly sync double effect. I stop here, sorry.
Rudolf, thank you very much, Rudolf. That was great. And to be equitable, guys, that was about 4 minutes of BVI's view from Germany. So I'm going to give you each, Ross, coming up next, 4 minutes. But we're already getting questions on CSDR settlement discipline in the question boxes. So we must allow time for that at the end, CSDR settlement discipline. But Ross Barrett, what's the IA? You may share some of those thoughts from Rudolf, but you may have your own thoughts. What would you like to highlight to Charlotte now you have her undivided attention for 4 minutes?
Yeah, well, thanks for the 4 minutes. I'm not sure I'll take 4 minutes. I agree with almost everything Rudy said there, pretty much as ever. Very sensible comments. I think, so I very much live on the market side of things. So my first thing would be to say, you know, the point that Rudy picked up about this endless cycle. And yes, there's this whole thing about exchanges versus other venues. And I would agree with that. But I would take that point further, actually, and say it's never been more challenging for firms, certainly our firms, and even for brokers, much as I'm not wishing to defend them particularly, with Brexit, with COVID, you know, now is not the time for regulatory tinkering. Now, sure, you know, there's a review, but if it's substantive and it's going to add value, then yes. Otherwise, just leave it, because actually firms have implemented MiFID only 2 years ago. Having minor differences between the UK and Europe and different regimes, which will take more time, more cost, more operational, more training. Actually, I would encourage the European authorities and the UK to just stick to the big things. So obviously we're not saying do nothing, but sort of an endless long set of proposals of tinkering are not what firms need right now, actually. You know, MiFID, the largest piece of financial legislation ever produced, you know, firms have just absorbed this in real terms, 2 years, now Brexit, now COVID. They don't need a whole bunch more tinkering. And I think, you know, the SME research is a good example of that. Frankly, I mean, yes, in principle, we kind of support it, but really it's tinkering at the edges, you know, so I would stick to the things that really make a difference. That's number one. And that's meant in a sort of positive way. I think the second thing that I would highlight is liquidity in fixed income markets. If we're just looking at fixed income, there is a bit of an obsession with transparency, and transparency is good in itself. You know, particularly in fixed income markets, I think that's a very problematic starting point. And I think I would encourage European authorities to move away from that starting point. Transparency has a value, but really liquidity is really what you need. So you need both. There's a scale. So more and more transparency and you get less and less liquidity. And particularly in the world we live now, where since the financial crisis, banks have had more and more regulation piled onto them, and, you know, perhaps rightly so, but that means that their ability to hold inventory, to create liquidity, to be true market makers in the true sense is extremely limited. So when the market comes under stress, it very quickly becomes a one-way market. You're looking for natural liquidity in large size, and everyone who's natural, which is the buy side, whether it's asset managers, insurers, hedge funds, they're all going in one direction. So you very, very quickly get a one-way market. So those would be my two things. Don't tinker with things unless it's really necessary. And two, think about liquidity, not just transparency. And I'll stop there.
Thank you. You came in at 3 minutes. I'm very pleased to hear. But I realise that we haven't got a sense of how important the audience feel about this. So I'm going to call for the first poll vote of the participants. We have 65 people listening. And the first one really is just to ask you how significant, looking backwards 2 years, how significant has regulation been for your businesses over the last 2 years? We will also ask a future-based question in a second. But if you could vote now, and we'll get that result up as we hear from our next panelist. But it'd be interesting to see how these 60-odd, 70 people on the call today feel about the impact of regulation has been, and we'll get a future dimension to that in a second. But Jason, Waight, if I could turn to you from a venue perspective, and again, in somewhere between 3 and 4 minutes, what are the main trading venue issues with MiFID II, please?
Oh, thank you, David. Good afternoon, everyone. I think there are 3 main issues, and the first relates to something that Ross just said on transparency, which I wholeheartedly agree with. Since MiFID II went live, around about 3% of the trades on our venue have been subject to real-time transparency. And the reason for that is it's mostly an illiquid market, right? And I think that one of the things that ESMA and the Commission really got right 4, 5, 6 years ago was that when looking at introducing transparency in this market was to take a very cautious approach, to bring it in gently and then to slowly recalibrate that over time. Now, that process, perhaps as a result of data challenges and Brexit, has maybe not gone as quickly or as smoothly as we might have hoped, but I still believe that approach was fundamentally the right one, and that it's a framework that the industry has invested a significant amount of time and effort into making work. So I'm not really persuaded at this point that fundamental revisions of that make sense, particularly as Ross has already said, in the light of COVID and other things that are going on. There is one change to the transparency regime I think most venues would like to see, which is removing some of the complexity around the fact that deferrals are not harmonised. I think that's probably a fairly easy change to make that could make the operational markets a little smoother without too much trouble. So the first is, please don't fundamentally rewrite the transparency rules, and as Ross has already said, keep a close eye on the impact on liquidity, because that's fundamentally what we care about. The second point, and the second real impact of MiFID II on trading venues, has really been one. MiFID II has raised the regulatory burden for venues, particularly in relation to reporting and the collection of personal information. So our costs have gone up. At the same time, we've seen sort of communication providers and service providers provide a very similar, often RFQ-based services that seem to exist outside of the regulatory perimeter. So we're concerned about how level that playing field is, and we think that's an area that needs to be looked at, either in terms of supervisory convergence or reconsidering the definition of what constitutes a multilateral trading facility. So that's our second point, is a more of a level playing field. The third point is a relatively straightforward one, actually, which is I think we're enormously supportive of the quick fix proposal to remove RTS 27 best execution reports. These are extensive reports that we are required to produce with an awful lot of information in them that seem to be singularly unused or unbeneficial to the industry. So I think we would very much support their suspension and indeed possible removal. I think we're totally open to a dialogue on how they could be replaced with something that the industry uses, but I think Ross would probably agree with me that his constituents have extracted very little value from all of the effort that the trading venues have put in thus far. So those are the 3 points we wanted to make about MiFID, David.
Jason, thank you very much. And I see we have a very attentive audience, because 77% of them has thought regulation as a significant or extremely significant impact on their business. And we've now got the future vote in front of everybody. So if participants can give a view of the same question going forward, that would be useful. And what we intend to do is ask this same question again at the end of this panel to see whether the panelists have managed to change your views about the future. But if you could vote now on the poll, or whether regulation has affected you, or will you think it will affect you into the future for the next 2 years, we will then close that poll. But in the meantime, I'm going to ask Charlotte to come back on anything she's heard there in terms of the highlights that those 3 individuals have just gone through. Charlotte, was there anything you would like to pick up on or comment on?
Yeah, no, of course. So, I mean, I'm not going to pick up or comment on the comments made on the MiFID II package that is currently in negotiation, because I think, well, I take it that you're very happy with the proposals, and let's see what happens on the political level, but that's not really for me to comment on. But I can comment then a bit on the part of transparency, and yes, I fully agree, these are challenging times with Brexit and COVID. So our idea now on the non-equity transparency part would not be to reinvent the wheel or make things more complex. I think it's rather the opposite. I think we want to try to make the regime simpler, less complex, and yes, in particular, I think we would like to have more harmonization and not have these various deferral regimes very different applied across member states, and create a lot of confusion, and I believe also a lot of wrong reporting. I think that's certainly one part that we want to clarify and harmonize on the European level to basically have a simpler regime going forward. I take your point on focusing less on transparency and more on liquidity. I think that's what we are trying to do. I would not be overly concerned on that. The point also raised then by Jason on the unlevel playing field, and yes, I agree that the MiFID II introduced significant additional requirements for trading venues or brought a whole new category of venues into the scope. And we have received quite some complaints also in that area that there is competition by unregulated entities. We also heard that there are different approaches across competent authorities. So this is something we're looking at, and that will be part of the consultation paper on the functioning of OTF. So you can see the consultation paper will not only focus very narrowly on the functioning of OTF, but will have a bit of a broader perspective, and also looking at questions who should be regulated, or what should be a trading venue and subject to regulation. And just maybe to come to one of Rudy's points about the complaint about exchanges lobbying. Well, I can tell you that exchanges are also complaining then all the time to us that they are not heard. So I think from our side, we try to keep everyone equally unhappy. So we listen to all of you, and then we try to understand what the real issues are and come forward with a proposal that makes most sense to us. So I can assure you we are not only talking to exchanges, we are talking to all market participants, and we are also consulting then with the broad community, and but we hope to get then also a lot of feedback from your side to take then a balanced view forward. And I think I would leave it there.
All right. Well, listen, the result was also of the poll looking forward, and unless I'm doing my maths right, we've dropped 10%. From 77% to 67% of those people who think the regulatory change will be quite significant over the next 2 years. I'm actually going to just throw a little bit to the panelists to comment on that vote and also express their own views. What do you think is going to happen, the significance and scale of business change looking backwards versus forwards? Ross, and also saw you shaking your head at times there. Ross, Barrett, would you like to comment on that? Do you feel that's material, the significance of regulatory change in the future? What's your views on this?
Yeah, I mean, I think it's going to be really big. And I was talking to some of our members about this yesterday, and I think the challenge, there's going to be major regulatory change. It's obvious, particularly if you're a UK-orientated firm, there's going to be major regulatory change. If you're in Europe, there'll still be regulatory change as well. And unless you have no UK business or no UK clients, then you're going to be affected. I think the challenge will be is which firms are able to digest this regulatory change and the divergence that is inevitable now. It is inevitable. It's already starting to happen. I'm not saying it's a good thing, but it is inevitable. And, you get some firms saying, but we don't want divergence. Like, I agree, but it's going to happen. So the question is, which firms are able to take that in, digest it, given their global business model, and work that into their operational processes. So I think it's probably never been more significant. Now, what the regulators can do to help, regulatory authorities, etc., is that, like I said, don't do too much. The less input there is, then the less output there is for firms have to assimilate, both in Europe and UK. And I've suggested to the FCA, I said, when they've asked, well, what should we do? I said, one option you could have is just do nothing. Just leave it. Just no matter how bad it is, just leave it, and then worry about it in 2 or 3 years' time. Let firms just carry on, deal with their business. So I think regulatory change will be very significant, and firms have to accept that there's going to be divergence, and they're going to have to digest it and operationalize that. And it's a change of mindset. I think it's going to get worse than it was before, frankly.
Ross, thanks for that. I heard what you say there. I don't know if you agree, or maybe Jason Waight can now comment. Is this like Formula One, where the rules change every season? The teams that win are those that take and embrace those changes and adapt rapidly and move on and don't fight some of this stuff? Or are you more in Ross's camp of one option could just be to leave everything unchanged? Jason, what's your view?
I'm very much in Ross's camp in the sense that what can be left unchanged should be left unchanged. I couldn't be more supportive of his non-tinkering message. If I tried, right? I think he's also absolutely right that firms that are good at managing change and complexity are going to be the ones that prosper over the coming years. And I mean, I think my overall sense is that I'm not sure I'll ever go through anything that was as big as our MiFID II change program again. I certainly hope not. So in terms of sheer size of
you're tempting fate now.
No, I really asked for it there, haven't I? Which is but my sense is, in terms of complexity, that is deepening almost by the day. So there will be a significant reg change program over the next couple of years, I think, without any doubt.
Rudolf, can I bring you in here? Do you think you'd agree the sentiment that those firms that can adapt to reg change is those that will survive and compete? What's your view from BVO?
Yes, I mean, we would agree that clearly regulatory change, and it's continuing, will drive consolidation in the industry. Small players cannot fulfill all these requirements. We clearly see that in our area, that there's a clear separation between pure portfolio managers, especially boutiques, who completely outsource the whole business, fund administration business, to dedicated white label providers in fund administration who are able to do risk management and all the reporting and regulatory and compliance stuff. So that is one fact. I think on the EU side, if we do it sensibly, we will have targeted changes to MiFID II, not just a quick fix, but especially also on the market structure side, like getting rid of the double volume cap, for example. I deplore my friends on the UK side. I mean, you have made your choice, but you have now two regimes. It's clear already in the benchmark regulation that you are not applying certain things till 2025. In CSDR, you are doing it differently. My friend Ross is working on a new UCITS Plus type of regime for UK fund managers. And therefore, I think the UK-based managers will have to work much more quickly than they think with two regimes. And not just an EU regime with some coloring on the side.
Rudy, thank you very much. So there is one area we can talk about, and we are getting there now, CSDR settlement discipline. Jason, I'm going to come to you first a little bit and then give Charlotte a right of reply. But can you just explain what's going on here? I mean, there is a delay in the European side to settlement discipline Article 7. The UK has made it clear that they're not going to be implementing the settlement discipline elements of it. But is that right? Have we got that right? Is there divergence in the CSDR portfolio?
Yeah, no, that's absolutely right. So as I understand it, the settlement discipline aspects of CSDR, so that's cash penalties for late settlements and mandatory buy-ins after a defined period of time for a settlement to fail, are now due to go live in the EU on the 1st of February 2021. Prior to that announcement, the UK government indicated that they would not be implementing that legislation, and our understanding is that although it's possible that it may be considered at some point in the future, it doesn't appear to be a policy priority for the UK government as it currently stands.
And Rudolf, do you have any specific views on settlement discipline, the Article 7 issue? The Article 7 issue.
First, we applaud the UK for having made this decision very quickly, because I think that clearly helped in persuading the EU to delay the application of Article 7, the CSDR settlement regime. I think now we have to work on the details within the next year. And our preliminary opinion is that probably the buy-side members can live with penalties, but the mandatory buy-in regime, especially for the bad effects on fixed income liquidity, Ross already described, should be carefully reviewed and, if possible, abolished.
Thank you for that. Ross and Charlotte, I'm going to bring you in. Charlotte, perhaps in terms of CSDR, I appreciate, maybe you can give us an update on, what is ESMA thinking around Article 7 and the CSDR consultation I believe you're conducting. What's Charlotte's the view from ESMA on CSDR?
Thanks, David. So what I can share with you is that there will be a CSDR review upcoming. And the Commission plans to consult on this in autumn, so I believe in October. This will not be a full review, but rather than a partial and targeted review to make sure that the objectives of the CSDR are achieved in a more proportionate, efficient, and effective manner. The review will also include the provisions on settlement discipline. So then I guess during the consultation period, you will have then time to express your views. I'm sure the Commission also closely looks at what happens in the UK. But then I believe this is also a bit more of a political issue than on how to deal with that. Then from the ESMA side, to let you know that we are feeding into the review process of the Commission. We are currently working on 2 reports, one on the freedom to provide services and the second one on internalized settlement. That were basically, we consulted the authorities and the main trade associations on these topics in June and July. And we expect them to submit those reports to the Commission in October. So, but from our ESMA side, there will be no consultation, but there will be the consultation from the European Commission coming up soon.
Thank you very much. I appreciate we've only got a few more minutes to run, and we will come back. So if there's any questions people want asking or addressing, then please come to that. We do have one
on CSDR, just really quickly. I think the thing is about CSDR, it's all been a bit sort of right at the last second, crash bang, and it's come in with Brexit as well and all that kind of stuff. But actually, right from the beginning, the industry across the board was saying this mandatory buy-in proposal was no good. You know, I think there are very few parts of the industry that were saying, yeah, let's do this. And it's only now it's actually come to the final stage of implementation that it's been addressed. And, you know, I think if it had been addressed earlier, then we wouldn't have had such an issue with this. But as my understanding, I'm not the CSDR lead, but the industry was saying for a long, long time, some years, right from the beginning, this mandatory buy-in was no good. And I think where you get, you know, occasional case where you get buy, sell side, other parts all going, not sure about this, I think that is a red flag, you know, not to do something.
Okay. All right, Ross, while you've got the microphone, there's a question coming around transparency. Do you see there's a difference in view about what happens generally to the transparency regime as between trading venues and sell side on one side and the buy side on the other? Or are you collectively in the same place about what needs to change or not change?
I think our view is, as asset managers, we want to get the best outcome for the client, right? So if the best outcome for the client is that we execute on exchange, then fine. If we are not executing on exchange, there's a reason for that. And, you know, other venues are offering better opportunities for our clients. And it's not great when we see exchanges lobbying hard to force us to execute on exchange, when you think, well, yes, but my client is paying the price for this. Now, clearly, you know, there are trade-offs, and the exchanges, to be fair, they provide reference prices and other kinds of things. And you can't have banks necessarily just being, you know, carnivorous around the exchanges in the middle. There is a trade-off, but, you know, being forced to execute on exchange by regulation to the detriment of our client is not a good outcome. And so we do like to see a balance. We do like to see competition. We do like to see the exchanges competing. We do like to see other venues providing opportunities for us to look at. Going back to the bad old days of, you know, one venue, we all go there and we all pay our tax to go through the exchange. That's not a good thing. You know, we want healthy competition between venues.
And Jason, bringing you in here with the supplementaries coming in as well, sure. Is it a very fine balance with all of these rules versus what it does to liquidity? If it moves too far, it then destroys liquidity. But you've got to get it right. Is that right?
I think that's exactly right, and I think that's the concern. I think that, you know, I think our position is twofold. Right, the first is we don't think there's anything fundamentally wrong with the structure and the approach that we set out, right? So we're not in favour of some of the suggestions to move to completely different models for transparency, not particularly because they're better or worse. It's just that we've spent a lot of money as the industry in making this one work, and I believe this one can be calibrated to work properly. And the question is, where do you strike that balance between the liquidity that clients need and protecting those liquidity providers? And that is a difficult question on which we continue to urge caution in an attempt to get it right. I don't think we have got it right yet, actually, and in that sense, I'm possibly aligned with some of the views on the buy side.
Okay, there are continuing times questions. I don't believe we have more live questions coming in, but we are going to put up the last question poll to see if you guys have made any difference to our audience in terms of the question, which is now, after we're listening to this panel, do they think there's more work to do than less into the future? So while everybody's voting on that, I was also going to change slightly and talk about one last issue, which is we can clearly see the UK has taken a different approach to settlement discipline. That's one little bit where they have come out very clearly and said they will not be implementing that versus the EU. Other than Charlotte, I'm going to come around to other speakers on the call here, maybe starting with you, Rudolf, in a second, is under that heading, what do you most worry about? I think you touched on it, Rudy, earlier, that if the UK took a different approach to something than the EU, where would you most be concerned about that? Or maybe in the opposite question is, where would you welcome a divergence? And then we'll go to Ross after that.
Obviously, UK-based asset managers are used on the continent as delegated portfolio manager in a lot of Luxembourg and other UCITS or AIF products. Therefore, obviously, any challenge to that model would be disastrous. Therefore, we are a little bit concerned with the discussion around the AIFMD review. We understand that currently, given that there are MOUs orchestrated by ESMA in place, that should not be the case. On the market side for fixed income, I guess we would really feel most the change if the MiFID quick fix on fixed income research could be implemented, because that is really a nuisance to all portfolio managers on either side of the channel.
Okay, and we've done a sterling job, guys, because we managed to convince some of the audience that there's actually more work to be done here. Ross, just very quickly, is there anything you hope will change between the UK and the EU in MiFID terms, or indeed anything else, or indeed you pray that it doesn't happen?
I think our view has been that divergence is inevitable. The FCA, Treasury, UK government will diverge. The European authorities will diverge. So it's important that we engage in that conversation in a constructive manner for our members and actually for the whole EU and UK economy. So where we have come in is we've said there are some things that we would like struck out because we don't think it makes sense. The best execution reportings, the RTS 27 and 28, things like the double volume cap, things where we feel like it's just not adding any value really to anyone, given that divergence is inevitable and you have to put your request in, otherwise they'll just look at somebody else's request. There are things that we'd like struck out. We're not looking for a bonfire of regulation. We're not looking for, for us to become Singapore on Thames. But there are things which clearly just don't make sense. And the CSDR settlement discipline was one of them. And there are these sort of outliers. And I think that's our approach. But there will inevitably be a divergence, and we'll engage with that. Okay.
Well, Jason, one thought from you on the same lines, because we must give Charlotte a final say. As
sure, very briefly, we completely agree that divergence is inevitable. The things that we would really like to see is sort of common rules on access to trading venues. It's currently incredibly confusing as to which clients can access what venues and then what their reporting requirements are, given that there are now two versions of MiFID II. So I think we are sort of three and a half months away from quite a bit of confusion and under and over reporting under the various versions of MiFID II. So I think what we might also need is a little forbearance from regulators in the early weeks post Brexit.
Okay. Well, thank you for that. And Charlotte, just any final thoughts from you? I promise not to make you talk about the Brexit word, and I've given you only 40 seconds in which to do it. So is there anything you could add there about what we've been speaking to, or any final thoughts from you, Charlotte?
Well, so maybe generally, I think, the whole idea of Brexit was to deviate from the EU rules. So I guess divergent is inevitable and was sort of the objective of leaving the EU. So of course, I guess this is what we are looking forward to, and then we will see then there might, and of course, this will impact the EU and vice versa. So I think this will keep us entertained for quite some time. I think at ESMA, from our side, we're trying to do as much as possible to prepare the market. I mean, well, we have those MOUs, so outsourcing will still be possible. Also, then after Brexit, so we are also working on republishing a number of statements that we did last year in the context of the no-deal Brexit, where we will now look into the context of a possible end of the transition period without a political agreement. On our side, we are trying to prepare market participants as much as possible, and we're also then regularly, of course, discussing this.
Okay, good. Listen, guys, I think on virtual you have to stay strictly to time, so we're just out of time now. Thank you so much for your attendance today and all the information you've shared with everybody here. It's been a very successful panel. Thank you again. I'm now going to hand back to Deb. I believe Deb is coming on to hand us over to the next session. So over to you, Deb.
I'd like to thank the panelists and everybody for joining this session. And a recording of this session will be available from next Thursday on the platform for 30 days after the event. And the next session in Stream 1 is the evolution of liquidity, performance, and service. And in Stream 2, it'll be the introduction of Fix Next Gen and the introduction to the new generation of fixed implementation options. And finally, we urge you to take a look at our sponsor booths in the virtual exhibit hall and network with other attendees in the networking lounge. Don't forget to join the live demos, and you can find an agenda in the information desk. We have a competition running for those who visit all of the sponsor booths in the exhibit hall. Will go into a drawing to win a prize. So again, thank you for joining this session and enjoy the rest of your day.